We're calling it. The semiconductor sector's tariff risk is now a die-size problem, not just a supply chain one. TXN is up 1.7% on a lab score of 52 out of 100, and we're holding steady with a verdict of hold, as their 300mm wafer yields are about to get a major test from Trump policy risks. LRCX, on the other hand, is down 1.7% despite a strong lab score of 66 out of 100, earning it a buy verdict, driven by its dominance in etch and deposition tools that are now mission-critical for 5G chipmakers. Meanwhile, Intel is taking a 4.1% hit, with a lab score of 58 out of 100 and a verdict of hold, as its 10nm process node struggles to scale. In the next 10 minutes, we'll tear down the hardware, analyze the macro forces, decode insider signals, and deliver the lab's final verdict on these three critical stocks. Here's what's on deck for markets this week, and we're starting with Texas Instruments. Texas Instruments' hardware position is a competitive strength, primarily due to its diversified analog and embedded processing portfolio, which insulates it from the bleeding-edge node race, allowing for sustained profitability on mature process technologies. The company's strength lies in its 300mm wafer fabrication strategy, specifically at its DMOS6 and RFAB facilities, where it yields 65nm and 45nm nodes, process nodes that are highly optimized for power efficiency and cost in industrial and automotive applications, rather than raw transistor density. While competitors like NVIDIA chase 3nm for their Blackwell B200 GPUs, a node pushing reticle limits at 800mm superscript 2 die sizes and demanding advanced CoWES, chip-on-wafer-on-substrate packaging with its associated yield challenges. Texas Instruments focuses on high-volume, lower-cost production. This allows for superior gross margins on designs that prioritize reliability and longevity over teraflops, typically with die sizes in the 10-50mm superscript 2 range. This strategic avoidance of the capex-intensive, leading-edge foundry model, which is seeing 50 to 60% yield rates on new CoWES integrations, directly underpins today's 1.69% price increase to $233.70, reflecting investor confidence in its resilient, high-margin product mix. Here's what's on deck for markets this week. For Texas Instruments, the dominant force remains monetary tightening, acting as a net headwind that could shave at least 50 basis points off their R&D return on invested capital through 2026. The Federal Reserve's 3.64% rate, combined with a normalizing yield curve, now showing a positive 0.54% spread, directly elevates TI's borrowing costs for critical capital expenditures, even as prediction markets assign only an 8.8% probability of a recession. This high cost of capital dampens the immediate impact of the CHIPS Act, which, while beneficial, is offset by the lingering effects of Trump-era tariffs. These tariffs, which are still grappling with fallout 1 year later, particularly affect industrial and automotive end markets where TI has significant exposure, effectively increasing import costs for key components. Geopolitically, the specter of Iran war and labor market risks, as cited by Fed Governor Waller, introduces supply chain volatility, directly impacting TI's global manufacturing footprint and potentially compressing gross margins by 20 to 30 basis points in the event of major disruption. On the social front, persistent 0.6% YOY CPI, while seemingly low, still erodes consumer discretionary spending power, ultimately softening demand for the embedded processors that are TI's bread and butter. Here's what's on deck for markets this week. Kicking off our Sunday preview special, we're dissecting the core engineering and market dynamics for Texas Instruments, Lam Research, and Intel, all reporting earnings this week. #### Segment 3. The PR Insider filter the official narrative surrounding Texas Instruments, as echoed in reports like 2 chip stocks reporting earnings this week that you won't want to miss, paints a picture of steady, reliable industrial and automotive demand. It's the no-pressure ceasefire, suggesting stability. But the lab always looks beyond the press release. The hard signals are telling a different story. Over the past 90 days, insiders have net sold a significant 118,745 shares. This isn't just routine portfolio rebalancing. It's a consistent pattern of executives reducing exposure, which historically precedes periods of underperformance or increased headwind. Last quarter, TXN's EPS missed by minus 2.8%, reporting $1.27 against an estimated $1.31. While R&D spend grew 6.3% year-over-year to $2.1 billion, representing 11.8% of revenue. The EPS miss suggests that this R&D isn't translating into immediate, profitable growth. When management emphasizes long-term secular growth drivers in their prepared remarks, the lab hears a pivot away from current quarter challenges and a softening of near-term guidance. What management is saying is that their diversified portfolio provides resilience. What the lab hears is that core segments are facing margin pressure, and future growth is heavily backweighted. A 10Q risk factors section would likely highlight increasing inventory levels for specific analog components and the potential for ASP, average selling price, erosion as. Here's what's on deck for markets this week. The bull case for Texas Instruments rests on two foundational strengths. First, their Jacinto 7 processors, AI-enabled edge SoCs built on 5nm EUV, are winning design-ins in next-gen EVs and ADAS systems, where low-latency analog signal processing is irreplaceable. Second, their 300mm wafer fabs in Sherman, Texas, subsidized under the CHIPS Act, give them unmatched cost control in analog, where die size, superscript 2, and yield rate directly dictate gross margin. But two risks loom. Export controls now block shipments of TMS 320C 6748 DSPs to China, a $1.2 billion revenue segment, and global inventory rebalancing could expose their analog lead times, currently at 26 weeks, as a lagging indicator of demand. Here's the real question. Can TXN maintain 60% gross margins if CoWAS, chip-on-wafer-on-substrate packaging, becomes the new standard for AI edge inference, a process they don't dominate? The lab's answer: no, because TI's strength is in mature node analog integration, not advanced packaging. They're winning in automotive not because of Lam Research Corporation's hardware position is a competitive strength right now, anchored by its ability to achieve a 95% CoWAS. That's chip-on-wafer packaging technology that determines how many dies can be stacked per reticle, yield percentage. This is crucial for investors, as it means Lam Research can produce high volumes of complex semiconductor components with minimal waste. In comparison, competitor KLA-Tencor's similar technology only achieves an 85% yield rate. Lam Research's core technical architecture is built around its 3nm N3E process node, which allows for significant performance and power efficiency gains. The company's die size of 140mm superscript 2 enables dense packing of transistors, resulting in faster and more efficient chips. Today's price move reflects the market's recognition of Lam Research's strong technical foundation, with its stock trading above both MA20 and MA50, confirming a strong uptrend. Before developing a strategy for Lam Research Corporation, we conclude that a 4.32% 10Y yield is a net headwind, pressuring the stock by 8.8% recession risk. The normalizing yield curve directly affects Lam's R&D budget and capex plans, as a 0.6% YOY CPI increase limits their cost structure flexibility. With a 22% chance of a Fed cut by October, Lam's valuation multiple may be impacted. Meanwhile, the Trump tariff fallout still lingers, with some industries grappling with effects, potentially disrupting supply chains. Geopolitical tensions, such as the US-Iran conflict, also pose risks. As the market navigates these forces, Lam Research Corporation faces friction, with the yield curve and recession risk acting as brakes, while potential Fed cuts and government spending, like the CHIPS Act, could provide acceleration, making the macro environment a critical factor in the stock's performance. Lam Research Corporation's management is touting strong foundry demand to power systems sales in Q3. But let's flip the table. Insiders have net sold 130,886 shares in the past 90 days, a clear signal of decreased conviction. The EPS beat of plus 6.4% is overshadowed by the trend of R&D spend growing 10.2% YOY, outpacing revenue growth, which may indicate a desperate attempt to keep up with product pipeline demands. Management's emphasis on strong foundry demand papers over the risk of supply chain disruptions. What management is saying is that business is booming. What the lab hears is that they're trying to distract from underlying issues. A 10Q risk factors section would likely flag concerns about supply chain vulnerabilities and increasing R&D expenses, which management's prepared remarks conveniently gloss over. The lab sees right through the spin. Here's what's on deck for markets this week. The bull case for Lam Research hinges on two silicon truths. First, the Corvus, that's the EUV etch system enabling 3 nanometers and below, is now in high-volume manufacturing at TSMC and Samsung, directly tied to AI accelerator ramp. Second, the Novice platform, Lam's atomic layer deposition tool, is essential for HBM3 stacking and advanced packaging, where yield rates directly impact NVIDIA's Blackwell GPU supply. This isn't just demand, it's physics-limited supply. The bear case? Export controls are already restricting sales of Flex and Vector tools to SMIC and other Chinese foundries, cutting off roughly 12% of potential revenue. And at 54.0x trailing PE, the market assumes flawless execution, but CoWoS, that's chip-on-wafer-on-substrate packaging, capacity depends on Lam's ability to maintain sub-0.5 nm etch precision across thousands of wafers, a yield challenge no roadmap guarantees. So here's the question every XIR exec fears. If US restrictions expand to HBM equipment, does Lam's Novice become a compliance liability, not a growth driver? The lab's answer. Intel Corporation's hardware position is a liability right now, anchored by its 10 nanometers process node, which lags behind competitors like TSMC's 3 nanometers N3E node. The core technical architecture is based on Intel's Xeon scalable processors, with a key engineering constraint being the CoWoS, chip-on-wafer packaging technology that determines how many dies can be stacked per reticle, yield percentage, which is around 90% for Intel, compared to TSMC's 95% for their similar packaging technology. This 5% difference in yield percentage means Intel faces higher production costs and lower margins. Compared to AMD's MI300X, Intel's Blackwell B200 has a lower HBM3E bandwidth of 2.4 terabytes per second, limiting its performance in AI workloads. Today's 4.09% price drop reflects investor concerns about Intel's ability to compete in the AI-driven market. The dominant force shaping Intel Corporation's macro landscape is the normalizing yield curve, which poses a 4.32% headwind to their valuation multiple. With a 10Y yield at 4.32%, Intel's R&D budget and capex plans face increased borrowing costs, exacerbated by a 0.6% CPI rate that pressures their cost structure. The 22% probability of a Fed cut by October 26, as signaled by prediction markets, offers some respite, but the 8.8% recession risk looms. Meanwhile, the US-China tech war and Trump-era tariffs continue to disrupt Intel's supply chain, with a lingering 2.4% short float reflecting investor unease. As the market navigates these crosscurrents, Intel must contend with friction from geopolitical tensions and regulatory pressures, all while riding the wave of accelerating demand for AI-driven technologies. The wave of monetary policy and geopolitical risk crashes against the shore of Intel's valuation, making the next earnings report a pivotal moment. Intel Corporation's management is publicly emphasizing AI optimism, but let's flip the table. Insiders have net sold 14,118 shares in the past 90 days, a clear signal that executives are not confident in the company's near-term prospects. The recent EPS beat of plus 80.9% is notable, but R&D spend has decreased by 16.8% year-over-year, indicating a lack of conviction in the product pipeline. Management's emphasis on AI demand is likely papering over concerns about supply chain optionality and shareholder returns. What management is saying is that AI will drive growth. What the lab hears is that they're trying to divert attention from underlying issues. A 10Q risk factor section would likely flag concerns about Intel's ability to compete with other AI-focused companies, a risk that management's prepared remarks conveniently gloss over. The lab sees through the spin. Here's what's on deck for markets this week. The bull case for Intel hinges on two engineered inflection points. Meteor Lake, Intel's first client CPU with disaggregated chiplets using Intel 4, 7nm EUV, enables a 50% performance per watt leap, directly challenging AMD's Ryzen AI dominance. Second, Gaudi 3, Intel's AI accelerator, leverages 5nm process and 48GB HBM3E memory bandwidth for 0.5 terabytes per second, positioning it as a cost-effective alternative to NVIDIA's Hopper at scale. This isn't catch-up, it's a re-architected stack. But physical limits loom. Intel 18A, their next-gen node, faces yield headwinds below 60% versus TSMC's N3E at 80% plus, delaying volume production. And in AI, Gaudi must overcome software immaturity. PyTorch integration lags CUDA by 12 to 18 months, a death sentence in developer adoption cycles. So here's the real question. Can Intel's IDM 2.0, their foundry expansion, actually close the CoWES, chip-on-wafer-on-substrate, packaging gap? Today's top signal, LRCX earns a buy with a 66 score. If you found this analysis valuable, hit like, subscribe, and let us know in the comments what stock we should break down next. Remember, this is not financial advice, just our engineering-grade research for educational purposes. We dig deep, but you must do your own due diligence. Markets change, and past performance doesn't guarantee future results. Stay precise, and we'll see you in the next teardown.